What if I told you that the next massive, like, life-changing financial windfall in artificial intelligence isn't going to come from some sexy Silicon Valley software startup?
Right. Or, a flashy robotics company.
Exactly. But from the dusty, boring, heavily ignored company that literally manufactured the printer sitting in your office right now.
It sounds completely counterintuitive. I know. I mean, you look at a legacy printer company and you just see a
Like a
dinosaur.
dinosaur. Yeah.
But, well, when you apply the raw math of extreme market panic to that dinosaur, you start to uncover something incredible.
Welcome to the deep dive. Today we are taking a look at a highly sophisticated, multi-layered investment strategy. And this is designed specifically for a $10,000 portfolio, targeting the semiconductor and AI hardware sectors as they stand right now in 2026.
Yeah, we're looking at some really extensive research here, institutional transcripts, raw data, all mapping out how to capture these massive nonlinear financial gains.
We are going to be exploring some really intense concepts today. Things like uh, asymmetric convexity, the mechanical traps of the options market, and why a boring 6% dividend can actually serve as a zero-cost lottery ticket.
Which is an incredibly rare dynamic to find, honestly. We are looking at an architecture that operates right at the intersection of deep value investing and extreme speculative mathematics.
Okay, let's unpack this. Our mission today is to decode these complex mechanics. Implied volatility, options pricing, fundamental tech analysis.
Right, getting into the weeds.
Yeah, and figure out how the smart money spots these tech breakthroughs before the rest of the world even knows they're happening.
Because we aren't just looking at stock charts here, we are looking at physical reality.
Exactly, because to understand where the money is flowing, we have to start by looking backward, right? At the bottleneck theory of AI investing.
That is the foundation of everything we are going to discuss today. I mean, artificial intelligence, for all its cloud-based mystique, is not magic.
It's really not.
It's bound by physical, electrical, and thermal realities. And, physical systems inherently have choke points.
Right.
When a massive flood of capital tries to push through a physical choke point, well, the companies that clear that blockage experience a violent expansion in value.
The data takes us back to the massive late 2025 and early 2026 rallies of companies like Micron, Western Digital, and Lumentum.
Yeah, those are huge.
If you were watching the market back then, you saw these stocks go absolute supernova. I mean, Micron practically doubled to near $400,
Yeah.
Lumentum near 290. And the common denominator was that they all solved a critical bottleneck in the physical infrastructure of AI.
Let's trace the sequence of those bottlenecks, actually, because it explains the present. First, you had the initial gold rush.
Right, the obvious one.
Yeah, every major tech company bought the foundational hardware, the graphics processing units, or GPUs. That was the era of Nvidia's absolute dominance.
Right.
But once you install 100,000 GPUs in a data center, you hit the very first physical bottleneck,
Which is what?
feeding data into those incredibly fast processors.
Right, because if the brain is processing information at lightning speed, but the eyes are reading the book incredibly slowly, well, the brain is just sitting there doing nothing.
That's a perfect way to frame it. The GPUs were starving for data.
Wow.
So the solution to that bottleneck was high bandwidth memory, or HBM, along with massive enterprise solid-state storage.
Okay.
HBM physically stacks memory chips closer to the GPU so the electrical signals have less distance to travel, and that is exactly what Micron and Western Digital provide.
So they were sitting at the bottom of a traditional, boring memory chip cycle, entirely beaten down by the market, right?
Exactly. But suddenly they had this highly certain, rigid demand coming from AI data centers. The market realized the bottleneck had shifted to them, and the valuations just exploded.
But then the bottleneck shifted again.
Always does.
Because once you have the memory and the processors working together perfectly inside one server, you need that server to talk to the 50,000 other servers across the data center without any lag.
Right, which introduces the bandwidth and transmission speed bottleneck.
Okay, so how does that work physically?
Well, moving electrical signals through copper wires over long distances creates too much heat and too much signal degradation.
So you lose the data.
Basically, yeah. So the physical solution is converting those electrical signals into light.
Lasers.
Exactly. That is where the optical connectivity companies entered the fray. Companies like Lumentum provided the optical communication modules and silicon photonics. They solved the data center gridlock.
I picture this like a massive city being built overnight. Nvidia is the construction company throwing up these giant skyscrapers, the
Yeah.
GPUs.
Right.
But once the skyscrapers are finished, everyone realizes the city is completely gridlocked. The roads are too small. Nobody can get to work.
It's a mess.
Yeah. So the company's building the highways, laying down the power grid, connecting the water pipes. Those are the ones who suddenly have all the pricing power.
And that leads us to the critical question. Where is the construction moving right now in mid-2026? The research identifies three main avenues where the bottlenecks are forming today.
Let's walk through them. The first avenue the research points to is next-generation connectivity, specifically companies like Astera Labs and MACOM Technology.
Yes.
Now, we just talked about optical connectivity with Lumentum. How is this different?
Astera Labs operates on a more macroscopic, well, actually a microscopic level. They manufacture high-speed connection chips, specifically things called PCIe and CXL retimers.
Okay, stop right there. PCIe and CXL retimers is a massive jargon drop. What is a retimer physically?
Imagine a long physical highway inside the server board connecting the main processor to the memory banks.
Okay,
When data travels down that microscopic highway at high speeds, the signal naturally degrades, it gets fuzzy.
like radio static.
Yeah, exactly. A retimer acts like a high-tech signal booster placed at intervals along the highway. It catches the degraded signal, cleans it up, perfectly reconstructs it, and sends it on its way at full speed. Without retimers, the internal traffic jam inside an AI server would cause the entire system to crash. Astrolabs solves that specific internal traffic jam.
And MACOM.
MACOM is similar, but they focus on high-performance analog and radio frequency chips that translate the digital data into the optical light signals we talked about earlier.
Got it. Okay, so the second avenue the research flags is upstream wafer fab equipment. Companies like Lam Research and FormFactor. This is the classic picks and shovels dynamic, right?
Yes, absolutely. If Micron is going to sell billions of dollars of high-bandwidth memory chips, they can't just snap their fingers and manifest them.
Right, they have to physically make them.
They have to build massive, multi-billion-dollar manufacturing lines. To do that, they have to buy etching and deposition machines.
Which are what, exactly?
Machines that essentially perform atomic-level 3D printing on silicon wafers. They have to buy these from an oligopoly of equipment manufacturers like Lam Research.
Okay, and FormFactor.
FormFactor provides the microscopic testing equipment for those exact wafers. It is invisible infrastructure to the average consumer, but it represents a highly certain fundamental explosion in revenue.
Okay, and the third avenue is bottom cycle specialty analog chips. Companies like Tower Semiconductor and Analog Devices.
Right. These are companies that haven't fully realized the AI boon yet
Why not?
because they are currently coming out of a long, painful inventory destocking cycle in traditional automotive and industrial sectors.
Oh, I see.
But underneath that temporary weakness, they are preparing for the edge AI hardware upgrades. You know, putting AI sensors into factory robots and autonomous vehicles.
Makes sense.
Tower Semiconductor, for example, is making massive equipment investments for silicon photonics manufacturing. But the broader market is just completely ignoring it because they are so focused on the short-term automotive slump.
Okay, I hear all this, but I have to ask a genuinely naive question here.
Go for it.
If artificial intelligence is so undeniably the future of the global economy, why can't you and I just take our $10,000 and buy Nvidia or Microsoft or Google?
Right.
Like, why do we have to go hunting for obscure wafer equipment manufacturers and signal retimer companies? Why not just buy the obvious winners?
Because of the mechanism of the efficient market. By the time your neighbor, your barista, and every financial news anchor agrees that a specific company is the undisputed king of AI, well, that stock is already perfectly priced.
What do you mean by perfectly priced?
The market is a discounting mechanism. It looks into the future.
Okay.
If everyone knows Nvidia is going to make massive profits for the next 10 years, institutional investors have already calculated those future profits and baked them into the price of the stock you are buying today.
Oh, wow.
You are paying for a decade of perfection up front.
So if I buy it today and they do perfectly over the next 10 years, my stock doesn't go up 10 times.
Very unlikely. Because that perfection was the baseline expectation. If you buy the perfectly priced, undeniable winner, you might not lose your money, but you are going to see mediocre, linear returns.
Like what?
7% here, maybe 10% there. If you are trying to turn a limited $10,000 portfolio into life-changing wealth, high-certainty trades are a mathematical dead end. You have to find the expectation gap.
The expectation gap.
Yes.
The difference between what the market thinks a company is worth today and what physical bottlenecks will force it to be worth tomorrow.
Precisely. Which brings us to a significant hurdle.
Okay.
Even if we identify these upstream bottleneck companies, a $10,000 portfolio buying standard shares of stock still won't generate the massive nonlinear growth we are looking for.
Right, because it's just not enough capital.
Exactly. To achieve that, the strategy dictates we must step away from linear stock buying and into the mechanics of risk and leverage.
So what does this all mean for our 10 grand? How do we structure it? The strategy outlines a very specific 70-30 split. 70% of the money, so $7,000, goes into buying spot stocks, actual shares of companies like Analog Devices or Lam Research.
The analysis calls this the ballast, or the defense.
And the remaining 30%, $3,000, goes into LEAPs.
Right. LEAP stands for Long-Term Equity Anticipation Securities. In plain English, they are simply options contracts that expire a year or more in the future.
Okay.
In this specific blueprint, the strategy suggests buying deep in the money call options on a highly volatile bottleneck company, like the retimer company we discussed, Astera Labs.
Let me make sure I understand the mechanics of this split. If I think about a high-performance race car, the 70% in spot stock is the chassis, the frame, the heavy engine block.
Right.
It keeps the car grounded. It provides stability. It isn't going to suddenly double my speed on its own, but it ensures the car doesn't fly off the track.
I like that.
The 30% in LEAPs, that is the nitrous oxide system. It is highly volatile. It provides massive explosive bursts of speed, but if I use too much of it, it can blow the entire engine to pieces.
That captures the dynamic perfectly. The heavy chassis protects you, the nitrous gives you the edge, but the most important part of that analogy is the ratio.
Why exactly 30% nitrous? Why not 50%? Why not 10?
Exactly. The blueprint relies on a mathematical concept called the Kelly criterion to determine that exact allocation.
The Kelly criterion. It sounds incredibly intimidating.
It can be. It was actually developed by a scientist named John Kelly working at Bell Labs in the 1950s.
Oh, really?
Yeah, he was working on information theory, how to transmit signals over long distances without noise ruining the data. But gamblers and quantitative investors realized his mathematical formula was the perfect tool for determining the optimal size of a series of bets.
How does it work in practice? Like if I'm using it,
The primary goal of the Kelly criterion is to maximize your long-term wealth growth while mathematically eliminating the risk of going bankrupt.
okay, that sounds ideal.
To use the formula, you only need two inputs, your probability of winning and your payout ratio, which is how much you win when you are right versus how much you lose when you are wrong.
Let's look at the actual numbers the research provides for this strategy.
Okay.
Based on the historical data of semiconductor equipment cycles and the very rigid physical demand for AI connectivity we just talked about,
Right.
the analysis estimates a 60% win rate for this specific strategy over a 12-month period.
So our first input is a 60% probability of success. Next, we need the payout ratio.
Right.
The analysis estimates that in a successful upward cycle, the steady growth of the defense stocks combined with the explosive growth of the options gives an average expected return of positive 35% on the total portfolio.
And in a downward cycle, like if the market just tanks,
Because the options are capped at a total loss of only that 30% bucket, and the defense stocks are highly resilient value plays, the expected average drawdown in a bad year is negative 30%.
okay, so if I take our average win of 35 and divide it by our average loss of 30, I get a payout ratio of roughly 1.16.
Correct. Now, when you plug a 60% win rate and a 1.16 payout ratio into the Kelly formula, the math spits out a theoretical maximum allocation of 25.5%.
Hold on. If I have a strategy that I know wins 60% of the time and pays me more when I win than it costs me when I lose, why would the math tell me to only bet a quarter of my money?
Right, it feels counterintuitive.
Yeah. If the odds are in my favor, shouldn't I bet 80% of my money to get rich faster?
That is the exact trap that wipes out amateur investors. It comes down to the brutal math of consecutive losses.
What do you mean?
Even with a 60% win rate, over a long enough timeline, you are mathematically guaranteed to eventually hit a streak of 3, 4, or 5 losses in a row. It is a statistical certainty.
Oh, like flipping a coin that is weighted to land on heads 60% of the time.
Yeah.
Eventually, you will still hit a streak of three tails.
Exactly. If you are betting 50% of your portfolio on every single trade and you hit 3 losses in a row, your $10,000 drops to $5,000, then $2,500, then $1,250.
Yeah.
You have lost nearly 90% of your wealth, and you no longer have enough capital to recover when the winning streak finally returns. You suffer what quants call geometric drag.
So by capping the extreme risk portion at roughly 25.5%, the Kelly criterion ensures that even when you hit that inevitable streak of bad luck, the chassis of your race car survives. You stay in the game.
Yes. And the strategy rounds this to a clean, safe, half-Kelly approach, utilizing the 30% bucket for the options and keeping the rest heavily defended.
Makes total sense.
But to truly understand why we are using options for that 30%, instead of just buying 30% more stock, we have to look under the hood at the mechanics of options pricing. We need to understand the Greeks.
The Greeks. Delta, gamma, and theta. I know this is where a lot of people feel completely overwhelmed. But if we are going to understand the strategy, we have to grasp these levers.
Absolutely.
Let's start with delta.
Okay, think of delta as the physical tether connecting the price of your option to the price of the actual stock.
Okay.
If an option has a delta of 0.7, it means that for every $1 the underlying stock goes up, the price of your option goes up by 70 cents.
So it mimics owning 70 shares of the stock, but it costs a fraction of the price.
Exactly. It's a measure of capital efficiency. You get the directional exposure of the stock without tying up the massive capital required to buy the actual shares.
Then we have gamma. The analysis relies heavily on gamma. What is it?
Well, if delta is your speed, gamma is your acceleration.
Yeah.
It is the rate at which your delta increases.
Okay, how does that work?
Here is how it plays out. As the stock price goes higher and higher, gamma mechanically pushes your delta up toward 1.0. So, as the stock rises, your option doesn't just keep making 70 cents on the dollar, it starts making 80 cents, then 90 cents, then a full dollar.
Yeah, really. So as I am winning, the math forces me to win faster.
Yes.
My 70 imaginary shares effectively multiply into 80, then 90, then 100 shares of exposure, and I didn't have to spend a single extra dime to get them.
That is the beauty of gamma. It is exponential momentum.
Wow.
But, options trading is not a charity. There is a cost to this leverage, and that cost is measured by theta.
The friction.
Yes, theta is time decay. An option is a contract with an expiration date.
Right.
Every single day that passes, the option loses a tiny fraction of its value simply because there is one less day for the stock to make a massive move.
That makes sense.
Imagine your option is an hourglass. Theta is the sand constantly running out of the bottom. If the stock just trades sideways and does nothing for 6 months, theta will entirely erode your investment, even if the stock never went down.
Which perfectly frames the core concept the analysis builds upon, asymmetric convexity.
Yeah.
Let's look at the Astera Labs LPE call as an example.
Okay.
Let's say I take $3,000 and buy these calls. What does asymmetric convexity actually look like for my portfolio?
What's fascinating here is the shape of the outcomes. Convexity refers to a curve in your potential outcomes.
Okay.
If you buy $3,000 of pure stock, your outcome is linear. If the stock goes up 10%, you make $300. If it goes down 10%, you lose $300. It's a straight line.
But with the option, yes.
With the option, the line curves.
Yeah.
If the entire semiconductor sector collapses tomorrow and Astera Labs goes bankrupt, your absolute maximum loss on that trade is strictly capped at the $3,000 you pay for the option. It cannot go to $4,000. It cannot ruin you. You have a hard concrete floor underneath you.
But on the upside.
On the upside, gamma takes over. If the stock surges, the acceleration kicks in. That $3,000 option can quickly generate the exact same dollar profits as owning $12,000 or $15,000 worth of stock.
That's incredible.
Your downside is flat and capped. Your upside is an accelerating curve pointing upward. That mathematical skew is asymmetric convexity. It is the holy grail of risk management.
It is an incredibly elegant mathematical structure. But, knowing how an option works doesn't tell us what option to buy.
Exactly.
How do we know which stock is about to surge? The research strongly argues that the key to massive wealth isn't reading financial news or listening to CEOs.
No, definitely not.
It is reading the raw data of the options market itself. The strategy looks for what it calls footprints in the dark.
The rationale here is simple, really. By the time a headline is written about an AI breakthrough or a new supply chain contract, the true insiders, the smart money, have already placed their bets days or weeks prior.
Right. They're already in.
If you buy on the headline, you are just providing the exit liquidity for the smart money to cash out their massive gains. You have to find their footprints before the news breaks.
Have you ever wondered how politicians or hedge funds always seem to buy right before a massive announcement? They leave footprints. So who exactly are these people leaving footprints?
The analysis breaks them down into 4 distinct groups.
Let's walk through who they are and how they operate, because it's fascinating.
The first group is what the research calls hyperscaler insiders. Now, it's important to clarify we aren't necessarily talking about illegal insider trading here.
Good to know.
We're talking about the software and hardware engineers working deep inside the massive server farms at companies like Google, Meta, or Amazon.
The people actually plugging the cables in and writing the AI models.
Right. A Wall Street analyst in a suit is looking at an Excel spreadsheet trying to predict the future. But the hyperscaler engineer is sitting at a terminal realizing, wow, our new GPUs are incredibly fast, but our training model keeps stalling out because the physical copper cables connecting the racks are overheating and dropping data.
They see it happening in real time.
Exactly. That engineer physically feels the technological pain point months before it shows up on a quarterly earnings report. They know with absolute certainty that their company is about to place a massive emergency order with an optical connectivity supplier.
So they go out and buy the stock of that supplier. Who is the second group?
The quant and volatility traders. These are the pure mathematicians.
Okay.
They often don't know or care what a company actually manufactures. They don't read earnings transcripts. They run massive supercomputers that solely monitor the options chain for statistical anomalies.
So they're just looking at the math.
Yes. If they see a sudden, inexplicable burst of aggressive buying in a random stocks options, their algorithms automatically piggyback on the trade. They operate on the assumption that someone else knows something, and they use speed to ride the wave.
The third group mentioned are the contrarian cycle investors.
These are the deep value hunters. They track global inventory levels of things like analog sensors or legacy memory chips.
Right.
When the entire financial media declares a sector dead and fear is at its absolute peak, these investors step in and buy the bottom. They are essentially tracking the physical supply and demand of the components, ignoring the market sentiment entirely.
And the final group are the supply chain trackers. I find this group the most interesting, honestly.
They are the hardware detectives. When a new Nvidia AI server is announced, these researchers will literally acquire one, tear it apart down to the screws, and document the bill of materials.
Wow. Literally tearing it apart.
Literally. They are looking for the tiny, obscure chips, like a specific power management circuit or a cooling valve. Once they identify the manufacturer of that obscure part, they buy the stock.
Because they know what's coming.
Right, knowing that as Nvidia scales production, this tiny supplier is going to see a tidal wave of unprecedented revenue.
Okay, so these 4 groups, the engineers, the mathematicians, the inventory trackers, and the hardware detectives, they are the smart money. But if you and I aren't tearing apart servers in our garage and we don't work in a Google data center, how on earth do we follow them?
Right, it seems impossible.
Yeah, we can't see what they're doing in secret.
We can't see their research, no, but we can see where they put their money. Because to get the kind of leverage they want, they have to interact with the options market. And massive amounts of money cannot hide in the options market.
Okay.
The research identifies the ultimate signal to track them. A combination of extreme deep OT call option accumulation and implied volatility right skew.
Okay, let's stop and translate that because that is the heaviest piece of jargon yet.
Fair enough.
Let's start with implied volatility, or 4. What is 4 and what is a skew?
Implied volatility is basically a measurement of how terrified or uncertain the market is about the future price of a stock.
Okay.
Now, in a normal, everyday stock market, what are people most afraid of?
They're afraid the market is going to crash and they will lose all their money.
Exactly. The dominant emotion is fear of the downside. So large funds naturally buy put options. A put option acts like an insurance policy. It pays out if the stock crashes.
Makes sense.
Because everyone naturally wants this insurance, the market makers charge more for it. Put options are generally more expensive than call options, which are bets that the stock will go up.
So the pricing naturally leans heavily toward fear.
Yes. If you plot the price of these options on a graph, the curve leans heavily to the left. The left side, the downside, is elevated. This is called a left skew. It is the normal, healthy state of the financial universe.
But the research is telling us to look for the exact opposite. A right skew.
Because very rarely a bizarre psychological shift happens. The market becomes terrified not of a crash, but of missing out on an explosive upward surge.
Buffalo.
Extreme FOMO. People become so desperate to capture the upside of a specific company that they stop buying puts and start wildly overpaying for deep out-of-the-money call options.
When you say out of the money, what does that mean mechanically?
It means the stock has to move a massive amount just for the option to be worth a single penny at expiration.
Okay, give me an example.
Imagine a stock is trading at $100. Buying a deep out-of-the-money call would be buying an option that only pays out if the stock hits $150. The statistical probability of that happening is incredibly low.
But when a massive amount of institutional money suddenly starts aggressively buying those exact, highly improbable options, paying massive premiums for them, the curve violently shifts. The right side of the graph elevates. You get an absolute right skew.
Which is the anomaly. It's like watching animals in a forest right before a massive earthquake.
I love this analogy.
The animals don't issue a press release to warn you about the earthquake. But if you are standing in the woods and suddenly thousands of deer, birds, and insects all start stampeding in the exact same direction, completely ignoring their normal behaviors and predators, well, you don't need a press release.
Their mass, irrational movement is the signal.
Exactly. When the smart money starts wildly overpaying for deep out-of-the-money calls, they are fleeing toward the upside. They know the earthquake is coming.
The research details 2 specific case studies of this exact phenomenon from early 2026. Credo Technology and ARM Holdings. Let's look at Credo first because it perfectly illustrates the mechanism.
Credo Technology, ticker CRDO. At the time of the anomaly, the stock was trading quietly around $100 a share. It was a relatively boring tech stock.
Yeah.
But suddenly, the quantitative scanners lit up. They spotted a massive, inexplicable accumulation of call options being purchased at a strike price of $260.
Wait, they were buying options that required a $100 stock to shoot to $260. That's an insane jump.
Exactly. The mathematical probability of those options expiring worthless was calculated at over 98%. Anyone buying them was essentially setting their money on fire. It was financial suicide. Unless they knew something. Unless an engineer inside a hyperscaler knew that Credo was about to announce a massive exclusive data center networking contract. The buyers were entirely willing to lose a small amount of premium with a 98% probability because they knew they would make 60 or 70 times their money on the 2% chance that the news dropped.
But here is where the strategy shifts from just following the smart money into exploiting a mechanical trap.
Yes, this is crucial.
The research explains that by buying these massive amounts of out-of-the-money calls, these institutional buyers aren't just betting on the stock. They are actually weaponizing the market against itself. They are triggering something called a gamma squeeze. We have to explain the how and why behind a gamma squeeze, because this is the engine of the nonlinear gains we are hunting for.
To understand how a gamma squeeze works, you have to look at the market from the perspective of an options market maker.
The market maker. These are the massive financial institutions that actually sell you the option when you click buy on your brokerage app.
Right. Think of the market maker like a casino. The casino doesn't want to gamble against you. They don't care if the roulette wheel hits black or red.
Right.
They just want to collect a tiny guaranteed transaction fee on every single spin of the wheel. They want to remain completely mathematically neutral to the direction of the stock market.
They just want to facilitate the trade and collect the toll.
Exactly. But when a massive hedge fund comes in and suddenly buys $1 billion worth of those $260 call options on Credo Technology, the market maker is the entity forced to sell them those contracts.
Oh.
Now, the market maker has a massive problem. They are no longer neutral. They are what is called naked short.
Meaning, if the stock actually does explode to $300, the hedge fund gets rich, but the market maker has to pay them out of their own pocket.
Yes. The market maker faces theoretically unlimited losses. And market makers despise risk. They are allergic to it.
So what do?
So to protect themselves, to hedge their risk, the market maker's algorithms automatically go into the open stock market and buy actual shares of Credo Technology stock.
Why do they do that?
Because if the stock does surge to $300, the actual shares the market maker just bought will also surge in value. The profits from those shares will offset the massive losses they owe the hedge fund on the options. They have neutralized their risk.
Oh, but here is the beautiful mechanical trap. When the market maker goes out and panic buys millions of shares of the stock to hedge their risk, well, that massive buying pressure physically pushes the price of the stock UP.
Precisely. And this is where gamma returns to the story. As the stock price ticks higher due to the market maker's own buying, the math of gamma dictates that the options they sold are now closer to being in the money.
Okay.
Their risk exposure has mechanically increased.
So the market maker's computer algorithms look at the new price and say, warning, the stock went up, our risk just expanded, we must buy more stock immediately to stay hedged.
So they buy more stock,
Ugh.
which pushes the price up even higher, which triggers the algorithm to buy even more stock. It becomes a vicious, self-fulfilling feedback loop.
Wow.
The stock price isn't going up because the company announced better earnings or a new product. It is going up entirely because the mathematical formulas force the market makers to blindly panic buy the underlying stock.
That is a gamma squeeze. It is a mechanical rocket ship.
And that is exactly what happened with our second example, ARM Holdings. The analysis shows ARM had an extreme right skew. The market makers were terrified of the upside risk from new edge AI chips, so they charged astronomical premiums for the call options.
They kept buying.
But the insiders and the quants kept buying them anyway. The sheer volume of options forced the market makers to continually buy the stock, driving ARM higher and higher in a completely momentum-driven frenzy.
Okay, listening to this, it sounds like a foolproof treasure map. All I have to do is scan the market, find the extreme momentum, look for the implied volatility right skew, where the calls are way more expensive than the puts, buy the calls, wait for the market maker to trigger the gamma squeeze, and collect my winnings. It sounds easy.
It sounds perfect in theory.
But financial markets are brutally dynamic. The reality is far more dangerous. What looks like a brilliant, mathematically sound opportunity on Monday can morph into an absolute death trap by Friday.
Yes.
And this leads us to the most dramatic pivot in the research material we are reviewing. Here's where it gets really interesting.
It is a critical pivot. The analysis documents a sharp, violent shift in the market dynamics around April 24, 2026.
Let's lay out the scene. Early in the analysis, the strategy was focused on companies like Intel and Cisco Systems. The thesis was that these were cheap, left-side value plays. They had high dividends, their price-to-earnings ratios were low, and the options chain was just barely starting to show the microscopic footprints of call accumulation. The plan was to buy in cheaply, establish the defense, and wait for the AI narrative to slowly catch up to them over the next year.
The assumption was that the investor had time, but real-time market data proved that assumption dangerously, wildly wrong. The market did not wait.
The data reveals a massive sudden explosion. Intel didn't sit quietly at $24 a share. Almost overnight, it surged 26%, skyrocketing past $82.
That's crazy.
Cisco suddenly jumped to $88. Advanced semiconductor packaging firm ASX, which was another supposed sleepy, boring value play, shot past $31, and its PE ratio completely ballooned to over 50. The entire landscape mutated in a matter of days.
The catalysts hit far faster than the models anticipated. For Intel, the surge was likely driven by a sudden breakthrough on their highly anticipated 18A manufacturing node, combined with a massive Wall Street rumor about spinning off their foundry business into a separate entity. For Cisco, the market suddenly woke up to the fact that standard Ethernet networking was taking a much larger share of the AI data center build-out than the proprietary Nvidia systems. The fundamentals caught up instantly.
Now, hold on. I'm genuinely confused here. I need to take a step back.
Sure.
We just spent 20 minutes talking about how massive momentum and upward surges are the signal we want. Intel just surged 26%. The gamma squeeze is happening. The stock is flying. Why is the analysis suddenly calling this environment a death trap for new money?
Right. It seems weird.
Yeah. If Intel just went to 82, shouldn't I jump in right now and buy the call options to ride the wave to 100?
That instinct, the fear of missing out, the desire to chase the green numbers on the screen, is the exact psychological trap that destroys retail investors. To understand why jumping in now is financial suicide, we have to introduce a concept called IV crush, implied volatility crush.
Let's unpack IV crush mechanically. How does it destroy my investment if the stock is going up?
Think back to our discussion on implied volatility. 4 is the price of uncertainty. When Intel was sitting quietly at $24, nobody cared about it. The uncertainty was very low. Therefore, the options were incredibly cheap. If you bought then, before the news, you made a fortune.
But now it's different.
But now, the stock is at $82. It is the lead story on every financial network. The gamma squeeze is in full violent effect. The implied volatility curve has skewed violently to the right. The animals are actively running out of the forest.
The market is terrified the stock is going to run away from them.
Exactly. The market is terrified. Intel will go to $150 tomorrow. Because of that massive panicked uncertainty, the market makers have jacked up the price of the call options to astronomical levels. If you buy the option now, you aren't just paying for the stock's underlying value, you are paying a massive panic premium. You are buying the frenzy.
I see. It's like trying to buy flood insurance during a hurricane. The insurance company will still sell it to you, but they're going to charge you an absolutely extortionate premium because the water is already rising.
That is a perfect analogy. You are paying maximum price for maximum panic. Now, let's play out the scenario. Let's say you buy the massively expensive Intel call option.
Okay.
The next morning, Intel officially announces the Foundry spinoff. The news is officially out. The press release is published. What happens to the uncertainty?
The uncertainty completely vanishes. Everyone knows the exact truth now. There is no more mystery.
Precisely. And when uncertainty vanishes, implied volatility drops to near zero instantly. The hurricane has passed. The sky is clear. What happens to the value of your flood insurance?
It plummets because nobody needs to buy it anymore. The panic premium evaporates.
Exactly. Even if the Intel stock price stays perfectly high at $82 or even ticks up a little bit to $85, your option contract loses 80% of its value in a single second.
Wait, really? 80%?
Yes. You were absolutely right on the fundamental direction of the company. The stock went up. But your portfolio was completely destroyed by the underlying math of the volatility curve.
Wow. That is brutal. You predict the direction of the company perfectly, but you still lose all your money simply because you overpaid for the panic.
Yes. Buying into a stock after the IV has skewed, right after the momentum is public knowledge, is catching a falling knife. The research is highly explicit on this point. Once the right skew is absolute and the stock has already run, your macro safety net is entirely gone. The risk of IV crush outweighs any potential fundamental gains.
So we are left facing a massive paradox.
Yeah.
If we chase the high-flying, exciting AI stocks like Intel, ARM, or Nvidia, the mechanics of IV crush will ruin us.
Exactly.
But if we just stick with completely safe, boring stocks that never move, we don't generate the nonlinear, life-changing returns we need for our $10,000 portfolio, we are stuck in the middle. So what is the ultimate strategy?
Right.
The data points to a concept they call the holy grail of this market environment, cognitive arbitrage alpha.
It is also referred to in the modeling as the extreme barbell matrix. The goal of this strategy is incredibly difficult to execute, which is precisely why it is so lucrative. We need to find the rare intersection of two completely contradictory market forces.
We need extreme fear and extreme greed to exist in the exact same asset at the exact same time.
Yes. Think of a physical barbell. On one side, the heavy side, we need a company with a massively depressed valuation, a high dividend yield, and a legacy business model that the broader market honestly believes is dying.
Okay.
This provides our high safety margin. It acts as our armor against IV crush and broad market downturns because you cannot crush the volatility of a stock that nobody is excited about.
That's the defense. But on the other side of the barbell.
On the other side, we need to look deep into the microscopic data of the options chain and see those hidden footprints of extreme greed. We need to see deep out-of-the-money call accumulation building quietly in the background.
We essentially need to find a company that looks like an absolute dinosaur to the general public in the financial news, but that the deep dive quants and the hardware engineers know is secretly building a rocket ship.
That is cognitive arbitrage. You are profiting off the disconnect between public perception and physical reality. And as of late April 2026, the analysts ran the screens, filtered out all the noise, the momentum traps, and the IV crush dangers, and revealed that there were really only two surviving true left-side assets that perfectly fit this impossible criteria.
The two targets are HP Inc., ticker HPQ, and Hewlett-Packard Enterprise, ticker HPE. I want to spend significant time breaking these two companies down, because this is where the theory becomes actionable. Let's start with HPQ.
HPQ is the consumer and enterprise PC and printer company. If you ask the average investor about HPQ, they will tell you it's a dying legacy business.
For sure.
People don't buy desktop computers anymore, and printing is a relic. Because of this narrative, the market currently prices HPQ with a dismal price-to-earnings ratio, or PE, of just 7.6.
Let's contextualize that. A PE of 7.6 means you're only paying $7 for every $1 the company earns. For a technology company in the middle of an AI boom, that is absolute rock bottom. I mean, Nvidia's PE is routinely in the 50s or 60s.
It is priced for bankruptcy. Furthermore, HPQ pays a massive cash dividend of roughly 6%. The broader market views it as a slow-moving, unexciting utility company.
That's the dinosaur side of the barbell. But what does the options market say?
The options chain is telling a completely different, highly aggressive story. The research data shows massive, quiet accumulation of deep out-of-the-money call options building up for expirations in late 2027.
Really?
Yeah, the smart money is aggressively betting that this dinosaur is about to sprint.
So what is the hidden catalyst? What physical reality do the hyperscaler engineers and the supply chain trackers know that the broader market is completely ignoring?
It is a massive dual-engine hardware catalyst scheduled to hit in late 2026. The first engine is regulatory and structural. Microsoft is officially instituting the end-of-life protocol for the Windows 10 operating system.
Which means no more security updates.
Exactly. And for a global corporation, a hospital network, or a massive bank, running an operating system without security patches is a violation of compliance. They cannot legally do it.
Wow, okay.
This forces a massive mandatory hardware upgrade cycle across the entire global corporate landscape. Millions of machines must be replaced.
A forced hardware refresh. But why wouldn't they just buy cheap standard laptops? Where does the AI come in?
That is the second engine. This forced upgrade cycle perfectly collides with the mass market arrival of true AI PCs. We are not talking about a standard laptop that has a web browser to access ChatGPT. These are machines built with dedicated hardware called NPUs, neural processing units.
What does an NPU actually do differently than a normal computer chip?
Well, a standard CPU is a generalist. It does everything okay. A GPU is great at rendering graphics and training massive models in the cloud. An NPU is purpose-built to run complex AI mathematical models natively, locally, directly on your physical device, without ever sending a single byte of data to the cloud.
Why is that local processing so critical? Why not just use the cloud?
Latency and privacy. If you are a doctor analyzing real-time patient data, you can't wait for the data to travel to a server in Virginia and back. You need zero latency.
Right.
More importantly, if you are a defense contractor or a massive financial institution, you cannot legally upload your highly classified internal data to a public AI model hosted by a third party. You must process that data internally.
That makes total sense.
The enterprise sector needs local AI processing power. The smart money is betting that HPQ is perfectly positioned to capture this explosive, forced supercycle of highly profitable enterprise-grade AI hardware sales. The market is entirely asleep at the wheel looking at printer ink sales while the structural tidal wave builds.
I love this. It perfectly fits the cognitive arbitrage model. Let's look at the second target company, Hewlett-Packard Enterprise, ticker HPE. This is the server, networking, and data center side of the original Hewlett-Packard empire that split off years ago.
It's a very similar narrative setup. HPE is priced by the market as a slow, lumbering, legacy enterprise IT company. Its forward PE ratio is around 11.8. It pays a respectable 2% dividend. The consensus narrative is that they have completely lost the AI server manufacturing race to the newer, flashier companies like Dell and Supermicro.
The market sees them as an also-ran.
Yes. But once again, when we look at the options chain, we see the anomaly. The data shows a distinct volatility kink, a highly localized, inexplicable spike in implied volatility for specific far-out call options. Someone is quietly buying massive upside exposure.
So what is HPE's secret weapon?
Yeah, what is the bottleneck they are uniquely positioned to solve?
Heat, or rather the thermodynamic mitigation of heat. As we discussed in the very beginning, the new generation of Nvidia processors, the Blackwell architecture and the ultra-tier chips coming after it, are incredibly powerful. But that power requires massive electrical wattage.
Right.
And physics dictates that electrical resistance generates heat. These new chips run so hot that they literally melt traditional air-cooled data centers. You can't just install a bigger air conditioning unit and point a giant fan at the server rack anymore. The air physically cannot carry the heat away fast enough to prevent the silicon from catching fire.
Exactly. The physical limits of standard thermodynamics have been breached by the sheer density of AI processing. The only physical solution is a transition to direct liquid cooling. You have to run chilled fluid directly over the processors or immerse the entire server board in specialized dielectric fluid.
And what is the market failing to price in about HPE regarding liquid cooling?
The market is forgetting HPE's history. Years ago, HPE acquired Cray.
Cray. the legendary supercomputer company. They built the massive mainframes for the military and national laboratories.
Yes. And because supercomputers have always run incredibly hot, Cray spent decades pioneering and patenting the world's most advanced high-performance computing architecture and direct liquid cooling systems. HPE owns all of that deep patented engineering. The smart money leaving footprints in the options market is placing a massive concentrated bet on a very specific outcome. As entire nations begin building massive sovereign AI infrastructure projects, they're going to realize that Dell and Supermicro cannot handle the extreme thermal dynamics at scale.
So HPE swoops in.
HPE is poised to win massive, exclusive, multi-billion-dollar sovereign AI contracts simply because they are one of the only legacy players with the patented thermodynamics to keep these massive GPU clusters from physically melting down.
The cognitive arbitrage here is brilliant. Imagine you were walking through a neighborhood garage sale. You see this incredibly heavy, ugly, dusty old iron safe sitting on the grass. The tag says doorstop $20.
Right.
Everyone is just walking right past it looking at the shiny new bicycles and electronics.
Hmm.
But you happen to be wearing a pair of thermal imaging goggles. And when you look at that rusty safe, you can clearly see that the inside of it is glowing with the intense thermal heat of solid gold bars.
That is the essence of the strategy. The public stock market looks at the 7.6 PE ratio and sees the heavy, useless doorstop. But the institutional options market, the thermal goggles, sees the massive value of the AI PC supercycle and the liquid cooling monopolies hidden inside.
And what makes this strategy so resilient is the psychology of the safety margin.
Yeah.
Because HPQ pays a 6% dividend, that acts as a concrete, physical floor under your investment.
Exactly. Let's compare this to a pure speculative growth play. The research mentions a highly popular quantum computing company called IONQ. Now, IONQ also has an extreme right-skewed options chain. The market believes quantum computing is the future, and this might be the next trillion-dollar company, but IONQ has virtually no revenue. They burn through massive amounts of cash every quarter just to keep the lights on. If the quantum computing revolution takes 5 years to materialize instead of 1 year, IONQ runs out of money and goes bankrupt. If you invest in them, you face a very real 100% risk of total ruin.
But with HPQ,
With HPQ, if the AI PC thesis is delayed, if the corporate upgrade cycle takes 2 years to play out instead of 6 months, you don't go bankrupt. You just sit there holding a profitable company and collect a 6% cash dividend every single year. You are literally being paid by the company to wait for the broader market to realize it made a mistake.
which brings us to the final and perhaps most crucial section of our deep dive today. We have explored the theory of bottlenecks. We have broken down the intense math of Greeks and convexity. We know how to track the smart money, and we have identified our targets, HPQ and HPE.
Yes.
Now, we have to translate this entire theoretical financial architecture into actionable, precise execution steps for our hypothetical $10,000 portfolio. The strategy calls this executing the evolution barbell log.
This is where we transition from academic philosophy to hard execution. We take the barbell concept we just discussed and we polarize the capital allocation to an absolute extreme degree.
Let's walk the listener through the exact numbers. The blueprint outlines a very specific split. We are taking 80 to 85% of our total $10,000. So between $8,000 and $8,500. And we are deploying it strictly into purchasing the spot stocks, the actual shares of HPQ and HPE. This is our ultimate defense.
Right. You are not buying options with this money. You are buying ownership in the company. You are locking in that rock bottom PE valuation. And most importantly, you are locking in the right to collect those dividends.
Okay.
This massive portion of your portfolio is completely immune to time decay. Theta cannot touch it. And it is completely insulated against IV crush because you aren't paying a single penny of volatility premium. If the market panics tomorrow, your shares still pay the dividend.
And then the remaining 15 to 20% of the portfolio, roughly $1,500 to $2,000, goes into purchasing the deep out-of-the-money LEPS call options, the offense, the nitrous oxide.
You purchase call options that expire a year or more in the future at strike prices significantly higher than the current stock price, perfectly aligning with the hidden catalysts we discussed.
Now, here is the ultimate financial hack presented in the entire body of research, and honestly, it is brilliant in its simplicity. They call it generating zero-cost lottery tickets.
Yeah.
Let's walk the listener through how the actual math on this synergy works.
It is an incredibly elegant closed-loop system. Think about the heavy side of your barbell. You have $8,500 sitting safely in HPQ stock. That stock yields roughly a 6% annual dividend. Over the course of 1 year, that $8,500 generates about $510 in pure liquid cash simply for holding the shares.
Okay, I have 500 bucks in my account.
Now look at the offensive side of the barbell. Because HPQ has been entirely ignored by the general market, its implied volatility is incredibly low. There's no panic premium. The options are dirt cheap. You can take that $510 in cash generated by your safe, boring dividend and use that exact cash to purchase your deep, out-of-the-money lay PS calls.
Think about the absolute elegance of this, you guys. Your safe money, the armored chassis of your portfolio, is physically generating the cash flow that pays for your hyper-risky nitrous oxide bets. Let's play out the worst-case scenario. Let's say the bet completely fails. The AIPC cycle is a total bust, the market never cares about HPQ, and your options expire completely worthless. What have you actually lost?
You have lost absolutely nothing from your initial principal. You only lost the dividend cash that the stock generated for you. Your original $10,000 is still perfectly intact. You survived.
But if the bet hits?
If the bet hits, if the hidden catalyst triggers the gamma squeeze and HPQ is suddenly aggressively revalued by Wall Street as a premier AI hardware company, your cheap options absolutely explode in value due to the convexity we discussed. Your portfolio goes parabolic, generating massive nonlinear wealth. And the entire explosive mechanism was funded by the underlying cash flow of a boring asset.
It's an incredible structure. Now, the research does briefly touch on an alternative tactic. What about the stocks that have already exploded? The ones we missed, like Micron or Astra Labs, where the IV is already crushed or the premium is too high. The blueprint mentions something called the wheel strategy.
Yes, the wheel strategy is a mechanical way to interact with high-flying, hyper-volatile stocks without taking on the massive risk of bulling them at the absolute top. Instead of buying the stock and hoping it goes higher, you act as the insurance company. You sell cash-secured puts.
Let's break that down mechanistically.
You find a terrified market participant, a bear, who is absolutely convinced that Astra Labs has run too far and is about to crash. You sell them an insurance policy, a put option. You promise to buy the stock from them at a lower price if it crashes. Because the implied volatility is currently so high, they pay you a massive upfront cash premium for that peace of mind.
So I collect the cash immediately. What happens next?
If the stock stays high or goes higher, the insurance policy expires unused. You keep the massive cash premium as pure profit. If the stock does crash, you are obligated to fulfill the contract and buy the stock, but you are buying it at a steep discount from its high using the cash you secured, and you keep the premium. It is a highly efficient way to harvest the panic premium from terrified market participants.
However, the research explicitly notes that for a smaller $10,000 portfolio, the capital requirements to act as an insurance company on expensive tech stocks are often way too high. The wheel strategy ties up too much cash. That makes the barbell strategy, utilizing the cheap options on HPQ and HPE, the vastly superior mathematical path for this specific module.
If we connect this to the bigger picture, this specific strategy is a profound lesson in the core philosophy of wealth preservation versus wealth generation. Most retail investors fail because they let human emotion dictate their timing. They watch a stock like Nvidia and they try to guess the exact day, the exact hour that the stock will pop.
Which is statistically impossible to do consistently.
It is entirely impossible. The barbell strategy removes the arrogance of timing from the equation. You accept the fundamental truth that you cannot predict the exact day a gamma squeeze will initiate. So instead of trying to predict the timing, you build a rigid mathematical structure that allows you to survive the waiting period indefinitely.
Right.
You use deep value dividends to buy yourself infinite time, and you use strategically placed options to buy yourself asymmetric, life-changing upside.
We have covered an incredible amount of ground today. We started by mapping the physical bottlenecks of global AI infrastructure, from the starvation of GPUs to the necessity of memory, down to the thermodynamic limits forcing liquid cooling. We dove deep into the dangerous mathematical waters of delta, gamma, theta, and the mechanics of a gamma squeeze.
We really did cover a lot.
Yeah, we saw how chasing the headline momentum of a stock can lead to utter devastation through IV crush if you arrive after the uncertainty vanishes. And finally, we arrived at the profound safety of the cognitive arbitrage barbell, utilizing the dividends of ignored legacy companies like HP and HPE to fund zero-cost lottery tickets on the future of enterprise tech. I want to thank you, the listener, for joining us on this intense intellectual expedition.
It is a complex architecture to digest, but understanding the underlying mechanics reveals so much about how financial markets truly function beneath the surface level of the news. But examining this entire framework raises a very important question, one that extends far beyond just semiconductor investing.
What's that?
The entire strategy we outlined today relies on the market fundamentally mispricing legacy assets like HPQ and HPE simply because the human crowd is blinded by shiny new things. The strategy relies entirely on the human flaws of fear, greed, impatience, and short-term thinking.
Okay, where are you going with this?
Well, as artificial intelligence begins to aggressively automate and optimize the financial markets themselves, as hyper-advanced algorithms become better at reading supply chains, predicting bottlenecks, and pricing options perfectly, will these inefficiencies and cognitive arbitrages disappear forever?
Oh, wow.
Will the machine perfect the market? Or will human psychology, which ultimately writes the code and drives the panics, always ensure that fear and greed create blind spots for the patient investor?
That is a phenomenal question to leave off on. If the AI is eventually trading the AI stocks, does the house finally win every single time, or does the human element always leave a messy fingerprint we can track?
Yeah.
It is something for you to mull over the next time you look at a stock chart or see a massive headline. Until next time, remember to look past the roulette wheel, ignore the noise, and keep questioning the blueprints of the consensus.
Goodbye and trade wisely.